Thank you, sir, for those very brief but encouraging remarks on the need for consolidation. Now, I would like to invite Mr. Rajat Madhok for his views on the impact of RBI guidelines for wholly owned subsidiary model for foreign banks in India.
Good morning, members on the panel, audience, students of IIFT. Thank you for having me over to speak at the symposium. A fairly topical subject for discussion. Impact can be very, very far-reaching in an economy and a country like India. The regulations or the proposed changes are still in draft stage. At this point of time, the RBI has put forward a discussion paper and are inviting banks' views on this. So it's kind of an area which is transformational. So it's very important to kind of go through some of the salient aspects and some of, I think, the feedback that foreign banks would have on the proposed changes, or how they would want something as far-reaching to be implemented. So if you look at the Indian banking sector, which has kind of gone favorably over the last decade, we see the growth in the total assets in the banking system. You have the growth in the profit after tax. And if we compare the Indian banking system with that of some of the other countries or peers, in terms of how the banking sector has performed in India, it's done reasonably well. And that goes in line with the kind of governance that RBI has, talks about the risk management systems of banks in India, and all banks, nationalized banks, private sector banks, foreign banks. I mean, what are some of the trends we see which will drive growth? Some of these were discussed in the morning sessions. We talked about urbanization. We talked about the needs in infrastructure, which are essentially coming from supply-demand imbalances across energy, climate change. Huge, $1 trillion spend on infra. How do we finance it? What kind of impact would it have in balance sheets? Do we have the public debt markets to support that? Globalization and India's linkage, again, something we discussed about decoupling in the morning session, but a big driver of today, investments inbound into India and outbound from India, drivers of mergers and acquisitions, and fundamental changes in the business models of Indian companies. Technology, again, we discussed a bit on that in terms of payment systems, but the entire UID, the rollout enabling mobile payments and its impact on commerce will be huge. And regulations. And I think we will talk a bit about regulations when we discuss the draft framework of the wholly owned subsidiary. So the view for the Indian banking sector is that there is significant growth, which we forecast across retail, wholesale, SME, and rural sectors. And we see the Indian domestic banks having established very strong presence across all these three models. The private sector banks having grown through aggressive branch expansion, product innovation, and a service proposition. And if we really think about what are the revenue pools for the banks, it's a very small percentage of the revenue pool which is currently fully accessible to foreign banks. With that backdrop, we talk about what is currently proposed as the operating framework for the conversion of foreign banks to wholly owned subsidiaries. Sorry for the small font. I've tried to kind of summarize all the points on this slide. But there is some discussion around a single form of presence across entities. So whether they are banks or they are NBFCs or whether they have broker-dealer entities. Capital adequacy norms. The fact that you would be a locally incorporated bank, you would have to have a local board. You would need to comply with the local acts around Companies Act, Banking Regulations Act, other statutes. The eligibility to raise non-equity capital in the form of innovative perpetual debt instruments, Tier 1, Tier 2 capital. Branch guidelines for expansion, which is, I think, could be any key area of discussion between RBI and foreign banks. Priority sector requirements at par at 40% with local banks. and a graded path to achieve that. No explicit parent guarantee allowed to strengthen the subsidiary structure. The RBI might ask for standby letters of credit. Again, we'll discuss a bit of this in a few slides from now. Repatriation of profits, dividends. Again, we talked about restrictions on downstream ownerships of subsidiaries. And I think more importantly, a listing of the local subsidiary and a dilution to 74%, and potentially its impact on M&A, as Mr. Tansile was talking about consolidation, and how does that drive the Indian banking sector, M&A. So if we just think about the potential scale of what a far-reaching guideline or a regulation like this could do, there could be a large set of opportunities for foreign banks. If you have an at-par treatment for branch expansion, it significantly opens your ability to mobilize deposits and then deploy these deposits in financing across the entire corporate sector, mid-corporate SMEs, retail. Currently, when I spoke about the addressable market for revenue pools being limited from foreign banks, if you have the presence and if you have the physical presence to capture these opportunities, you can capture rural and semi-urban affluent, which we think, if you really took a look across the districts in India, are 50 districts in 6 states, pretty much in line with what was said by Sanjay Chatterjee in the morning session. And you can create commodity value chains from pretty much grassroots level to the way these are fed into the larger markets across the country, and create opportunities in crop financing, commodity exchanges, hedging supply chains. And the very fact that foreign banks in India could raise domestic capital, one can increase their ability to do more, lend more, take far greater risk, credit risk, and increasingly deploy those resources where they think is the right profile for risk return. So if you just do a simple matrix about what are the customer segments and what are the product segments, and how do foreign banks could potentially compete today, and how they are constrained today, and what they could possibly do. The table is in front of you. Pretty much across large corporates, mid-markets, SMEs, foreign banks could potentially offer pretty much all of their product offerings, and then do that in a more focused and a niche way across the retail segment, which is HNIs, affluent, mass affluent. We've had obviously various discussions with the RBI and the regulators at various levels, but there have been very public reactions to this proposed change in guidelines. I just kind of summarize all of them on a slide, including those of Mr. Subbarao, the RBI governor. And I guess the perspectives, there are a couple of different perspectives here, which is those of the banks, those of the regulators, and those of the investors. Now, if you just spend about 5 minutes on what are the pros and cons, and what could potentially be things or feedback that regulators should consider when they kind of go ahead and try and formalize this working paper into regulations. I mean, the obvious thing is the huge flexibility for foreign banks to expand their branch network, their ability to issue local capital, a graded time frame of 5 to 7 years to achieve what are their priority sector targets, potentially lower tax rates. I'll talk about this a little later again, and the ability for local listing and inorganic acquisitions. I've used the term issues, but essentially what are potentially either issues or where foreign banks could want regulations to have more flexibility or more in line with their concerns. If you look at the first one, I think as things stand today, the very fact that if you convert to a wholly owned subsidiary, there is an incidence of capital gain and stamp duty, and on the conveyance of the assets to a wholly owned subsidiary. And the RBI should think about either giving a one-time dispensation on that. We have a precedent even when the Stock Exchange of India was corporatized. So this is something which has happened in the Indian environment, though not for banks. If we think about restriction on parent support through guarantees and SBLC, standby letters of credit, currently a lot of global financial institutions and investors deal with foreign banks globally across jurisdictions. And the key comfort for them is the bank's global credit rating, the bank's global balance sheet. And that really translates to their ability or comfort across jurisdictions. And the very fact that you then change that and say that you have to take a call on the local balance sheet could potentially increase costs and transaction costs for custody services, for trade services. So something that the RBI should think about. A requirement of a host country regulatory approval, which is more from the fact that where is their foreign bank originally domiciled and their approvals to implement this process. Assumption being these approvals will come through, but it's something to think about. When we talk about changes in governance model to local board managed structure from what it is today, I think there are other things to think about. Currently, a lot of foreign banks use their hubs, regional hubs, for help in MIS, risk management, reporting, technology. If the regulators were to insist that the wholly owned subsidiary would then have to invest into creating all of this infrastructure into the wholly owned subsidiary in India, that is going to drive up significantly the one-time costs to make this transition. If you see the liquidity framework, a lot of the foreign banks today use their overseas branches to book offshore loans. What would be the treatment in the wholly owned subsidiary structure? Would the bank still be permitted to use their to use the branch network? So this is, or would RBI be okay that the local bank or the wholly owned subsidiary places money with overseas branches and then they can be used to book deposits? But it's something we need to think about, as the foreign banks have been working in one particular way regarding these transactions. A lot of the foreign banks have ancillary activities through entities in capital markets, brokerage houses, as well as non-bank finance companies. What is the consolidated structure for such a group rather than a single presence or a single monoline bank is something which is not clear today and something which needs to be spelled out and discussed. If you think about foreign banks, priority sector, and then meeting priority sector norms, especially on agriculture, it's not something that foreign banks in India have experience in. If they get the branches, they will have the reach, but it exposes banks to a systemic risk, and there are shareholders to kind of approve that lending into that sector and making that investment. Maybe something to think about is enhance the definition of what could be potentially be priority sector or lending to agriculture in terms of doing it indirectly. Can we look at indirect agri lending or infrastructure to qualify as overall priority sector requirements? Could foreign banks' subscription to bonds under the Rural Infrastructure Development Fund of NABARD qualify for agricultural lending? These are things that the regulator has to think about. It is yet not clear that if foreign banks become wholly owned subsidiaries, will they have an equal access to the public sector banking wallet, which is currently pretty much shut out for most of them. We spoke about tax treatment, and I wanted to spend a minute on that. Besides the one-time tax incidents on stamp duty and capital gains, there's also would be an incremental tax on dividends. Currently, foreign banks get taxed at the rate of 42% for their operations in India, and then the branch of the foreign bank can pretty much repatriate dividend to their head office. Under the proposed wholly owned structure, a wholly owned subsidiary in India of a bank would pay a corporate tax rate at 33%. It would then have to pay a dividend distribution tax of 16.6%. which adds up to an aggregate tax liability of 49.8%, higher than the current 42%. It's again something that, as foreign banks, would definitely represent to RBI in terms of making this arbitrage go away. I think in conclusion, the only thing that I would kind of say is that, please ignore this slide. I would say is that I think the discretion to stay as a 100% subsidiary or its discretion to dilute should be there with the foreign bank, and currently it's not clear whether this will be mandated or will this be at the discretion of the foreign bank converting to a wholly owned subsidiary. So it's a pretty interesting I think roadmap to the future, has implications in terms of fundamentally changing the way foreign banks have kind of worked in India, can potentially grow in India. It has significant, I think, implications on the consolidation of the banking sector, as mentioned by Mr. Tansale. So it's something that we are all foreign banks are working very closely with each other and working with the regulator to, I think, have an effective framework drawn up so that we can implement this in the most efficient manner. Thank you.
Thank you, Mr. Madhok, for those valuable insights on a topic which is a subject of current interest for the student fraternity.